Hey guys, I'm Matthew Pillmore, president of VIP Financial Education, and this is VIP's Financial Literacy Series, where I want to start taking a look at financial terms and topics that are crucial to your success in both your personal and business finances. And in these videos, I want to go beyond simply defining something or describing a term or a topic, and I want to discuss why it actually matters to you and how it can affect your personal situation. So today we're going to be looking at one of my favorite topics, compound interest. Now, when it comes to calculating interest, there are really two basic options here. You've heard of them both, simple and compound. Now, simple interest is calculated by multiplying the daily interest by the principal by the number of days that elapse between your payments. This is the type of interest that you're going to find in things like your auto loans, short-term loans, and of course some mortgages. Now, when making payments on a simple interest loan, the payment first goes towards that month's interest, with the remainder going towards principal. The interest for each month is paid in full, so it never really accrues. Compound interest, on the other hand, adds some of the monthly interest back onto the loan, so you actually end up paying new interest on old interest. Compound interest is applied to both loans and deposit accounts, which means it exists on both sides of the coin, both money being spent and money coming in being earned. Now, I want to include a formula on the screen here just to make things a little easier to understand. But the simplest way to look at compound interest is by thinking of it as interest on the interest. So let's dive into some examples of simple and compounded interest. Say you invest $1,000 at 6% simple interest. This would actually mean that after the first year, $60 would be added to your account. In the second year, another $60 of interest would be added to your account. And the same goes on with the third, fourth, and fifth year. On the other hand, if your investment paid 6% compounded interest on an annual basis, now while it wouldn't make a difference on the first year, you'd start to see some major differences in the years thereafter. So let's take a closer look at this. After the first year, you'd receive the same $60 that you would with the simple interest calculation. In the second year, however, your 6% interest is going to be calculated on your entire new balance of $1,060, not just your original $1,000. And this produces an interest payment of $63.60 for the second year, which will then be tacked on to your original principal when calculating your interest for the third year. So every year throughout is stacking on itself. Remember, this is an example of compound interest on an annual basis. Now, you're going to be surprised how quickly this can add up. At 6% simple interest on just a $1,000 investment, you'd be worth $2,800 after 30 years, which isn't bad, but it's really not that impressive if compared to compounded interest. When you're using the compound interest, you would balloon to more than $5,700. Of course, compound interest gets even crazier the more money that's involved, and the compounding frequency is changed to something like semi-annually or even more frequently, like monthly rather than annually. So let's go ahead and add just one zero here to this hypothetical example. $1,000 isn't much, but let's see what $10,000 looks like. If you were to do this through compounded interest, that $10,000 over 30 years with 3 different compounding frequencies, annually, quarterly, and monthly. I want to keep the rate at 6%. Let's go ahead and start with the annual. In 30 years, you'd end up with $57,400, exactly 10 times the amount in our original example. Not much changes when you move to semi-annually. In fact, you'll end up with just $58,900 after 30 years. And let's see how this actually is influenced when we change that frequency once again to monthly. Over 30 years, you'd have over $60,225 when your frequency is every single month. Now, the differences here might not seem too significant when you put them side by side with a $10,000 or a $1,000 example. But the main takeaway is that compound interest matters greatly. It matters so greatly to your potential successes or failures financially that we even created a video called How to Turn $16 a Day into $5 million. So make sure you check out that video. I'll put the link in the description below. It is incredible. Now, on one hand, compound interest can work wonders for you, but only if you exercise patience. Patience and consistency are key, just like with everything. If you want compound interest to benefit you, you're making investments that compound over time. This is not to be confused with getting rich quickly. The other side of this is where compound interest can actually hurt you, and this is really where it matters the most for purposes of today's episode. It matters most on this side because compound interest can really cause great harm to you if your finances are not in order and if you're not aware of how it's affecting your credit. This is your credit card debt. This also includes perhaps even your mortgage, as well as your other non-mortgage related debts. Now, when you're not paying attention and you're not executing a really good financial plan, compound interest can keep you in debt for years and even decades longer than you need to be in debt. And there are better ways to handle this debt. And this is something that we discuss frequently here on this channel. So make sure you take a look at some of our most popular videos. I'm gonna also include some links to those videos in the description below as well. I wanna get you out of debt, and I wanna get you out from underneath the compound debt very quickly. Now, this has been an episode of the VIP Financial Literacy Series. I do want you to go ahead and comment below. Feel welcome to comment with any financial terms or topics that you want us to tackle in this series. And be sure to check out our next video in the series where we're gonna take an even closer look at the extremely relevant FICO credit score. While I always recommend Credit Karma over paying for FICO, FICO is still the score that's used by the majority of the banking institutions that we rely on to get some of our most popular debt weapons from. So we're gonna keep deep diving into that subject. It's very important to all of us. I look forward to seeing you on the next video. Until then, make sure you're a subscriber to the channel. Turn on the post notifications bell in order to get alerted every time we upload new videos. Go ahead and drop a like on this video if you are excited about us deep diving into some of these topics that we should have been taught in school and weren't. And until I see you on that next video, make it a great day today and take care.
Alrighty, so I realize that some of you have not gotten one of the single most popular budgeting tools available, not to mention it's free, and that is called the Cash Flow Cruncher. So what I want to do today is walk you through the process of downloading your very own copy. It comes in the form of an Excel spreadsheet, so it's very easy to use, and it's quick to navigate. So let's go ahead and walk through that process together. Go to cashflowcruncher.com, which will take you to the download page. Simply type your email address into the field to claim your free copy, and go ahead and select the red button. Immediately it'll pull up the download button, which will open a new Cash Flow Cruncher spreadsheet. The first page it'll open is the Cash Flow Summary tab, which is a non-editable page. It's very important to understand that this opening tab will not require you to put any information into these fields. This actually imports the data from the other tabs below. Now, if you've ever used an Excel spreadsheet, you'll navigate the spreadsheet by going to individual pages down here. And it'll start with the revenue and assets page. On this page, you'll want to itemize each individual income that you bring into the household or the business. Now, it's always been my recommendation that you create an individual cash flow cruncher for your businesses, an individual cash flow cruncher for your real estate, and an individual cash flow cruncher for your household.